All right. So first of all, I do want to thank you for your time and for your upcoming talk. But I just want to share to everyone on here who Alan Rosenfield is. He is I like this CIO, the Chief Investment Officer for Harmony Asset Management. It's a local company based out of Scottsdale with an office as well in Tampa, Florida. He has 36 years of experience. He's the former #1 ranked mutual fund manager by Morningstar and Lipper. And in general, he has extensive public speaking and television, print interview, and writing on various investment topics and strategies. He's been quoted in Business Week, Barron's, Investors, Business Daily, and USA Today. And he's also a competitive archer and a coach, which is obviously very important for your line of work. So,
Absolutely.
but thank you again, and I'm going to turn the mic over to you.
Thank you, Rabbi. The one thing he forgot, everybody, is, at least according to my wife, I'm also cute. So there you go. What I was going to do is, everybody's been watching the markets. They're going straight up. And I was going to kind of look at it from a different point of view. And that is from the point of view of risk. And the reason for that is what most investors forget is it's not just about how much money you make when you invest. It's the risks you're taking to make that money. Because in the end, it's not how much you make, it's how much you don't lose. And from that, I mean this. If you go back and look at the last 3 bear markets, so 2001 through 2003, 2008 to 9, and then this very brief one we've had, what you find is that unlike historical times, looking back over the last 50 years, because of the leverage and other things going on in the system, most people, the average investor, actually lost everything they made for the prior decade. And let that sink in for a second. Literally going back to zero. Now, the last time this happened was 1967, 68. If people remember back to those days, we had 10 years of weak markets, up one year, down the next. We had this super inflation from oil. If you bought at the peak of the market in 1966, it took you to 1982 to break even. And then we hadn't seen that in a while, and now the same thing's happening again. It's wiping out things pretty quickly. So that's why I'm thinking about things in terms of risk today. And in my mind, when we look at things, there are 4 elements that we can think about when we talk about risk. So first is the stock market. Second would be the bond market. Third would be the economy. And fourth would be inflation. Okay, those are the 4 areas. So if we look at the stock market and you just look at the returns, we were down about 36% at the peak, and we're basically back to even. So most people, when you talk about risk, they say, well, we made it all back. It's all good. Everything's looking great. But the problem is valuations are higher than they've ever been. Companies have been laying people off. Companies have been raising a record amount of debt and equity in the last 2 to 3 months. And you do that for 2 reasons. One, because you're worried you may need money. And secondly, because you can get it now. When things are bad, you're not going to get it. Nobody will buy. So to see these kinds of records happening right now makes me very worried, because the whole question is before all of this happened, if we just go to December of 2019, corporate debt was higher than back in 2008 when we had the last real fiasco. So now we've added even more in debt. And to give you an idea of levels, the average in the last 3 or 4 years, average monthly new issues of debt for corporations is between $20 and $30 billion a month. In May, we did over $1 trillion of new corporate debt, not government debt, just corporate debt, public corporate debt. This month through the beginning of this week, we've done over $19 billion already. So there's a lot of debt being piled on a lot of debt. And that's a concern for me from the stock market point of view. The second reason this is a concern, I'm reading today's Wall Street Journal. This is a front page article, and it's talking about new investors and how they're investing. And most of these investors are young, and they're under age 35 on average. And here are some of the quotes. Let's see. So we've got a guy who runs a bar who, because times are slow, has been buying stocks, and now he's buying options. We've got a woman here who lost her job but has taken the $1,200 the government gave her, and she's been investing it first in stocks, now in options. And then we've got a gentleman here who is giving advice online to other investors. And I'm looking for the exact quote here. Okay, here it is. Quote, "It took me a while to figure out that the stock market isn't connected to the economy," unquote, he said. I totally agree with him. Went on to say, quote, "I tell people there are two rules of investing. Stocks only go up, and if you have any problems, see rule number one." That's today's Wall Street Journal. That's a pretty dangerous situation. People don't think stocks go down, or they're going to get hurt, and they're going to get hurt badly. So I see things like that in the speculation, and I'm watching that institutions are not investing. They're pulling out, and it's retail that's running in. That typically is a very bad sign. There's a place you can trade. I don't know. Has anybody heard of Robinhood?
I did. Does that make
okay?
It's the app?
Yeah.
You'll have to fill everyone in on that, though.
Okay, yeah. So it's a free trading app where you can trade for free, set up an account, you can trade for free, no costs. Now, there's a reason why it's free. It's because they're selling all the data that you're trading to high-frequency traders. Now, let's define what a high-frequency trader is. High-frequency trader is an institutional group that uses wildly expensive computers that try and get as close to the exchanges as they can, because they're timing things in milliseconds. And what they're doing is getting all of your data and front running you. So you say, I want to buy IBM, and IBM's, just for argument's sake, at 190 to 190 and a quarter. They're jumping in, moving it to 190 and a quarter to 190 and 3/8 or 190 and a half. Your trade then goes off at 190 and a half. And by the way, they're busy selling it. And then next thing you know, the stock market's down again, or that stock's down again. And this is literally happening in milliseconds. And yet most of these people don't understand any of this is going on. The big guys aren't out to screw the little guys. They're out to make money. And they only have one rule, and that's make money. And ethics have nothing to do with it, and morals have nothing to do with it, and who else gets hurt has nothing to do with it. So, and I'm not saying I approve of it. In fact, I think what they're doing should be illegal, but the fact is that's the reality of the world we live in. And so for investors not to understand this means they're setting themselves up. Third area, bond market risk. Governments added over $6 trillion in debt this year so far. Okay, they're talking about doing even more. The problem with all of this is that sooner or later you got to pay this debt back, and the only way they can pay it back is by taxing you and me. So right now, if you look at the economy and you look at the stock markets or the bond markets, they don't agree with what's going on. And this is a big issue. It doesn't say who's going to win in the end, but when they don't agree, that tends to say risks are very high, which is what I keep coming back to, is all this risk. Stock markets are saying we're going to have a V-shaped recovery, okay? And what they mean by that is all the bad news is out, things are going to get better rapidly. And that's why the stock market has gained all that 35% back, and stocks are everybody's euphoric. The problem is the bond markets should be selling off if stocks are really that good, because you run to bonds for safety and then you leave them to go into higher risk. Yet bonds aren't selling off. So that says to me, so while the stock market, now I'm going to move this, see if you guys can see this chart. Hopefully you can see it. The blue is the bond market, and the purple is the stock market. Year to date, through today, TLT, which is an investment that looks at the 10-year and longer treasuries, is up almost 20% with the S&P flat. Now, that means people are buying bonds, they're appreciating, and that means there's fear about the stock market. So bonds and stocks don't agree. Now, the Treasury's been buying a lot of bonds, but they're buying less and less of them. And they're buying more of corporate debt and high yield junk. So my point from that is the information that we get, that we used to look at and say, I can analyze things because here's what stocks are doing, here's what bonds are doing, here's where expenses are, here's where PEs are, all these things. All of this is now being manipulated by the Fed. And what it means is you're not getting real accurate pricing information, right? Think about it if you wanted to sell your house. When the markets have been hot in the past in Phoenix, right? We've seen prices skyrocket. Everybody's outbidding everybody, and you get a great price. Doesn't mean that's what the value is. And in fact, there was a while, if you go back pre-2008, where building a house was cheaper than buying it because how far people were pricing things up, right? So you weren't getting real good pricing information. Think of that on a much more liquid situation because it's international as opposed to houses, which is very localized, right? And that's part of the problem today is you can't really analyze the risks and the rewards. Finally, when you look at the economy as compared to the bond and the stock market, what you're finding is that the economy doesn't look so great. You got well over 13 million people in this country unemployed. That's my analyst. His name's Teddy. You've got a lot of unemployed. A lot of those are not going to come back quickly. Large companies are busy laying people off. It hasn't really made the news, but I know for a fact that United and American have already started telling people, take a package to leave or we're firing you, and it's going to happen at the end of September because the money they receive from the government requires that they continue to pay people through September. And you're going to see this in a lot of businesses. One of the big food companies recently just raised multiple billions of dollars. At the same time, they announced layoffs of several thousand people. So the economy is not showing the kind of bounce back that stocks are showing. At the same time, we're also not seeing much in the way of inflation. A CPI came out today, it was down 0.1%. And yet we've added $7 trillion of debt from the government. The way I read all this, and I'll wrap it up with this, is that the reason we're not seeing inflation now is because the way inflation is analyzed is based on GDP. Okay, that's the gross domestic production of the companies in the United States. Typically, if the government were giving money to companies, or if companies were raising prices and people were getting wage hikes but having to pay more for things, that's where inflation shows up. Okay, but the government hasn't been putting money in the pockets of individuals. They haven't been putting it directly in companies. What they've been putting it in is the bond and the stock market. So we are seeing inflation. People say there's no inflation. There's a lot of inflation. It's asset inflation. And that's a really critical point. Stocks are way up. I'm looking at stocks that make no money and are selling at 1,000 times earnings. I'm looking at companies that are good, solid companies that are expected to have slowing revenues according to the companies, and yet they're at all-time high PEs. That's inflation. Now, will it shift to wages? We'll have to wait and see. One of the things I'm watching for is the temporary increase in money to people that are unemployed. It's supposed to end in July. If that becomes permanent, I calculated out the numbers based on an average work week. They will have effectively changed minimum wages from about $15 an hour in the highest states to over $23 an hour. If that happens, in order for companies to hire people, they're going to have to raise what they pay. And we're already seeing some of that happen. And if that happens, that means you now have wage inflation, which means they're going to have to raise their prices because their margins will disappear, which means you will see cost of everything going up. Now, all of a sudden, you'll have inflation if they do that. Now, if they don't do that, that's a positive sign, but you still have this inflation in the assets. And inflation typically has to get paid for somehow. In the stock market, you either have stock prices go down, that's the fast way, or they flatten out for a long period of time. You have to do it one way or the other at some point because you can't keep having inflation with no value, right? That's where the risk is on that side. So in summary, we've got risks all over the place. And it doesn't tell us the stock market's going to collapse tomorrow, but it does tell us that how much you think you're going to earn doesn't justify the amount of risk that you're taking to earn it. So if you can make 10%, but your risk is that you lose a third, in my mind, that's a really bad risk reward parameter. And that's where we are right now. And we're in that with bonds as well as stocks. So the big problem is there isn't a lot of place to go run. And with interest rates so low, which has been part of the Fed's whole plan, it's forcing people into stocks, but they've already been forced into stocks. So now the question is how much further can they push it? Japan's been doing this for a decade. Japan's had flat markets for a decade. Hasn't worked there. The Japanese government now is one of the 10 largest holders of all stocks in Japan, and yet they have a flat market. So I look at this and I just go, it's time to be nervous, but it doesn't tell us where things are going to be, and that's why we have to watch all of this. So that's the prepared remarks, and what I was hoping to do is just start having a discussion on the areas that are of interest, specific things you want to talk about, and we can go from there.
Okay, so two questions in the chat. First of all, thank you. For me, that's very informative, but I'm a novice. So the first question was, someone asked, what is the difference between stock and options? I know you used that. If you can give an explanation.
Absolutely, that's a really good question. So stocks. Common stock is an ownership in a company. Okay, and the way the capital stack or the way you look at a company is debt holders are at the top. So people that lend money to the company are at the top. They get paid out first. They get paid an interest rate. So just like when you borrow money to buy a home, you're paying the bank an interest rate. In this case, the company's borrowing money from you and they're paying you an interest rate. And if they default, if they go bankrupt, use Hertz as a perfect example. In the scheme of things, the bondholders are most likely to get paid their money back. Okay, then it's the preferred shareholders, and then it's common stock shareholders. So if you own common stock in Hertz and they go through Chapter 11, it's entirely likely you will lose all your money. That's what happens in a bankruptcy. But why do people own common stock? Because if you own Microsoft instead, or Tesla, if you want, or any of a number of companies that have gone way up, the bondholders don't participate in the upside. They get their interest. That's all they get. So the common stockholders are looking for appreciation. Now, options is a way to make a leveraged bet. And I'm going to give it to you simply, but it's actually fairly complicated math. They're using second and third derivatives to calculate values and things. And frankly, it's not a game I play 99.9% of the time. I don't consider myself an expert. There are guys that strictly trade options. But what options allow you to do is buy the right to own a stock at a certain price or to sell a stock at a certain price. And whereas 100 shares of a $100 stock means that you have to spend $10,000, 100 options, which gives you the right on 1,000 shares. Or 10 options give you the rights on 1,000 shares. You might only need to spend $1,000. So it's giving you leverage. So if the stock moves 10%, the option, depending on time, could move double or triple or quadruple that. Of course, the same thing happens on the downside. And the thing that complicates options is they're time sensitive. Typically, they're good for 3 to 6 months. You can get some longer now, but typically it's very short term. So if I buy 1,000 options of IBM, and at the end of the time period, the stock is lower than the price that I was willing to buy it for, I'll lose 100% of my money, okay? Whereas if it's gone up in value, then I'll get that increased value. So it's a leveraged way. Hopefully that explains it. It's a leveraged way to play in the stock market. And you can get a lot more sophisticated with options than that, but in its basic form, that's what it is. It's like simply saying, instead of buying a car and paying cash for it, you buy 10 cars and you borrow all the money from the bank. Okay, you're super leveraged, but you own a lot more than if you just bought the one car for cash. And then it's a case of, if it goes up, great, you'll make money. If it goes down, you're likely to lose a lot of money.
Thank you. I think
hopefully that explained it.
I think that did. Judy, did you want to ask something back about that? Because I know it was your question.
Well, something related to the investment. So the fixed annuities, I know you're going to get back the amount you invested in, but how likely is it for you to lose the piddly interest you're getting?
How likely is it to what?
To lose the interest that you're supposed to be getting.
Okay.
I heard that even though it's
basic
an annuity, there is some risk.
There is. Annuities, in and of themselves, are not guaranteed by anybody. Life insurance is guaranteed by the states. They back it up. But if you remember back in 2008 when AIG collapsed, annuities lost money. Now, it doesn't guarantee that you will, but if the company goes under, you can lose not only the interest on it, you could lose your capital. That is a possibility. High likelihood, if you use one of the high quality ones, is quite low. So I wouldn't be panicked about it if it's a high quality company. But AIG used to be thought of as a high quality company too. So there is some risk. It's when you get into the more esoteric types of annuities where they're saying you'll make the return of the stock market, but we won't give you any losses. That's where I start to get more nervous and say, okay, you really need to understand what it is they're doing and how they're doing it. Because over 6 months, they may not have a problem. But if in fact you ended up with a bear market that lasted years, how are they going to be taking the losses because they're not making you take them? So it's when you get into all the esoteric ones that I start to get nervous. Annuities otherwise have a good place. We have used them for clients. We don't work with annuities, but I've helped clients buy them actually because we've had got bonds, we got stocks, we got real estate, we got all of these things. And what we wanted was just an alternative that would generate income that under a normal circumstance we weren't going to be worried about, or even most abnormal circumstances, and where the bond markets couldn't guarantee that I could get the returns I might in this annuity. So there have been times that they're a very smart place to play. You got to be very careful about the fees. They still hide a lot of the fees. Unlike in our industry where everything has to be disclosed, most of the insurance companies can still hide a bunch of this. So you just want to dig in. But depending on who you've got, a simple annuity is not likely to become an issue for you over any period of time. That would be my guess. But, that's something that if you've got an advisor you work with, sit with them and just make sure that the company's still considered very high quality, rated by best. They don't have too much debt, these kinds of things, just so you can sleep at night.
Thank you. And what do you think about taking any money you have and putting it in real estate in this day and age? I'm wondering if the market is the bottom is going to fall out somewhat, and then you can get something at a better deal. But I see it's stronger and stronger and stronger. I just can't equate why we're having all these problems and the real estate keeps skyrocketing.
Well, that's a good question. Now, I'm not a real estate expert, but I've got several people I work with that are, and I've spent a lot of time talking to them. And here's what we're finding. The first thing about real estate you have to understand is real estate's like saying, I'm having a drink. Okay, what are you drinking? Is it alcoholic? Is it non-alcoholic? Is it in a big glass? Is it in a little glass? Is it cold or is it hot, right? It really hasn't described anything other than it's something that is liquid that goes down your throat, right? Or up your nose. Real estate's the same thing. Are we talking commercial or residential? Are we talking single family homes or multifamily homes? Are we talking in the commercial space? Are we talking about office buildings, or are we talking about factories? All of these things will matter, or retail, as to why are they doing what they're doing. And so they're all different. They all have their own situation. So the easy one to look at is retail, a commercial space, right? That's the highest risk because so many people have been for years anyway moving to online purchases, but with the COVID-19 happened even more. So you've got that kind of risk there as opposed to maybe office space or a factory space, which is actually industrial space has been growing the best. The reason, though, I think is the same reason that they're all, quote, been strong, depends where you are in the country, too. Phoenix is stronger than New York City right now. New York City's a mess. Phoenix is growing. New York City isn't growing. Phoenix hasn't had the kind of lockdown New York City's had. People aren't stacked on top of each other the same way. So, but the reason in general they've been moving is leverage. Is everybody and their brother borrows money up the, very high leverage oftentimes for these properties. Bottom line is the guys that I've talked to that I trust, some of the people from the Schottenstein family is an example of one of the biggest real estate families in the country. They're afraid to death of real estate right now. They think there are going to be some terrific opportunities, but they think you're going to see a lot of blood before the opportunities show up. So a little long-winded, but there's a lot to your question, actually.
Thank you very much.
So
sure.
Question in the chat. For seniors who want to have safer income, are bonds safer than stocks?
By their definition, yes, bonds are safer than stocks. But like everything that I've been talking about, it's really peeling an onion. There's so much more we have to discuss. So treasuries, agencies, municipals, corporate bonds. Those are the types of publicly traded bonds there are, okay? Then inside of each of these, you have to worry about credit quality and maturity date. Is it a 3-month, 3-year, or 30-year? All of that will make a difference. Now, let's talk about risk. When you ask, are they less risky? We have to define risk. In terms of default, yes, in general, bonds are safer than stocks, because if that company defaults, bondholders get paid back before the stockholders do. But there are other risks. Volatility. Bonds are actually more volatile than stocks. Nobody realizes that, or a lot of people don't realize that. Because if you hold it to maturity, you get, if they don't default, you get paid 100 cents on the dollar. But in the meantime, bonds do this. Let's go back to this chart. Just look at the blue one. That's just year to date, okay? Look at the volatility, down to around 5%, up to 25%, and that's in about a 2-week time frame. So, that's enough to make the stock market look scary. So bonds can be very volatile, and that is a risk if you need to sell it early. So that's one thing. Second thing is you have to look at the quality. If you owned Hertz, which is a piece of junk, and I don't mean that as an opinion, it's called junk debt. It's high yield debt. They've got a lot of debt and they don't have a lot of ways to pay for it. And that's why they're going into bankruptcy. Those are higher risk as opposed to a AAA piece of paper. The other risk is if you need liquidity. Back in 2009, 10, and 11, after the 2008 fiasco, Treasury Department and the Federal Reserve set up all sorts of new rules for banks. And what this did, without them realizing it then, but if they had understood the markets, they would have known it right away, is that they decreased liquidity when times are tough. When people get scared, liquidity drops. Now, what's that mean? It means it's harder to sell something, okay? You saw it in stocks, in that a stock that was trading at 120 all of a sudden is at 100, and instead of an 1/8 of a point spread or a penny spread, it might be a $1 spread or $2 spread. Okay, that's because the traders are stepping back saying, I'm not buying anything. Well, that happens in bonds even more. And you had a real liquidity problem. We bought, when the market screeched to a halt, we bought some 4-month, I believe it was Wells Fargo paper. So bank's not going anywhere. It's fine. I bought a 4-month piece of paper at a 4% yield. Now, right now, that same bond, I could sell it at a 0.6% yield. So, and it normally should be in that 0.6 to 1% kind of a range. I was able to buy it and get a 4% yield. That's because the spreads widened. Nobody was willing to buy. They were afraid. And so we walked in and said, thank you very much. We'll be glad to take it, because we knew we wouldn't have to liquidate it. But if you had to liquidate it, you got hosed, you got hurt. So when we talk about bonds, if it's long-term and you don't need it for next month or 6 months away, yeah, they'll be safer than most stocks. However, if we get a second round of COVID-19, as an example, or something that sets the markets off, if you needed to sell to get out, you could get hurt. Hey, you won't go to zero, but you might lose 10 or 15 or 20% of what the real value of the bond is. So there is risk to it. Let me answer it in the final way this way. In many of our bond portfolios, where we were doing it as hedges, where we were doing it for people that were really looking for long-term growth, but we just didn't like the markets, we're actually taking profits now. We're selling a lot of the bonds that we bought in the last 2-3 years. Not all of them, but a bunch of them. And I'm not telling you should be doing that, because without knowing your situation, any advice I give you is a waste of time. But what I'm telling you is, for certain kinds of clients that I'm working with right now, I see the potential for more risk than gain anymore because rates are so low again. So I'm taking the profit and walking away. So hopefully that helped answer it.
Thank you. Before anyone asks any questions, and I'm just letting everyone know, please do, if you have a question, you can either write in the chat or unmute your mic. But before anyone does, since I don't see any mics unmuted yet, did you want to talk a little bit about your own Harmony Asset Management, or that's up to you, since we didn't really self-promote you, as they say?
Yeah, and I certainly didn't come here to try and self-promote, but just so people have an idea, and I actually twist it to why I've set it up the way I have, because it's what I like. So I ran big institutional money for a number of years. I ran the high net worth group for Cantor Fitzgerald back in World Trade One back in the early 90s. And at that point, we worked for, back then, if you didn't have $5 million in cash, so we're talking almost 20 years ago, we couldn't help you. At the time, Goldman Sachs only required $1 million. And that was fun. We did some really creative stuff. And then I ran the mutual fund. What I decided with all of that was I liked working with people. And while working with people with hundreds of millions or billions of dollars is always fun, I always looked at it and said, you know, how much value am I adding as opposed to Goldman Sachs or anybody else? So when I set up Harmony back in '93, we went the other way. I said, I want to work with people where I can add value, which means where they're getting closed out. And I'll use one simple example. I've got a good client, a nice guy. We've been friends for a while. We managed some money, and his brother was the head of private equity at JP Morgan. And this client's very sophisticated, very successful, lives in Manhattan, so he's right next door to his brother, all of this. The rule was you had to have $10 million at JP Morgan, or you couldn't be in the private equity. His brother runs the place. Answer was no. So that's why he came to us. We did some private equity. We've done some other things. I'll brag. He just called me about a month ago and said, Alan, you outperformed absolutely everybody else. He now has well over 10 million at JP Morgan, and we embarrassed the hell out of him, which always makes me happy. But the point is, so we went to that smaller group because I like talking with people. That's what you didn't get to do when you run a mutual fund. And I like helping and seeing that there's some real value. And the wealthiest people in the world, they can get access to anything from anybody, anytime, anywhere. So we wanted to go the other way. So we basically manage money for individuals and small corporations. We run over $100 million right now. We've got 2 offices here and in Tampa. And really what we do is provide guidance. So we get paid to manage money. That's why I get a paycheck. But a lot of what goes in is simply advice, helping them raise capital for a business, sell a business, help them with their insurance needs. It could be any of a number of things. I get people call me and say, should I move now? What do you think about if I bought a new house, or I'm going to buy a car? And we'll talk about their cash flows and other things going on in their life. So we really act as an advisor. But at the end of the day, what we charge for and what we do is actually develop investment strategies that meet the risk parameters and the goals of clients, and then implement that. Was that too long?
No.
I've never been very good at short answers.
That's perfect. Okay, Sheldon, I see you have a question. What's up?
Is it true that members of Congress are not subject to insider trading? And if so, why should they be?
Why should they, or why should? I totally think that they should be in jail for insider trading. Okay. I can't get more blunt than that. I'm not 100% sure. I know there are 2 situations. One, there is a law I read about that does require that they don't do insider trading in ways, and that's what a couple of these guys, Congress people, I think senators, were recently brought up on charges on, although they haven't been charged that I know of. But I also have heard that there's a lot of gray area. There's a lot of area where they get away with it. I guess the way I'd answer it to you, and normally I don't get into politics at all because my job is not about politics. My job is about reacting to what anybody does and investing within the risk and goal parameters. But my belief is that we have turned Congress into an elite class. They pay themselves, they set their own rules, they exempt themselves from everything they put us into. So whether you liked or didn't like Obamacare is not relevant. It's the fact that they decided it wasn't good enough for them, that they have different rules for everything, and I don't understand it. They work for us, not the other way around. Frankly, I think as citizens, that's the biggest problem. Talking about riots and everything else, our biggest problem is that we have politicians that have no interest in solving problems of America. They have interest in power and money and nothing more.
Thank you. Okay. Thank you very much.
Sure.
I agree the same
That's
way.
the most I've said about politics in 37 years of business.
So Alan, here's a question that I got private message to me. How should someone choose an advisor? And the reason why they asked this to me, they added some context. Jeffrey Epstein was also a money advisor, a financial advisor, lost people's money, or maybe didn't, I don't know. But in general.
So was, yeah, go ahead, I'm sorry.
You're saying Madoff?
Yeah, Madoff.
Yeah, so that's the question. I'll let you answer that.
That's a really great question. In fact, I'll put in a shameless little PR here. One of my younger clients and a couple of her friends got together and wrote me an email with about 15 questions, and that was one of them. It was all about how do you deal with anything related with money. So how do you hire an accountant? How do you hire an investment advisor? All of these things. And we're doing videos on them. So if you go to our website, you'll start to see those over time, or if you go to YouTube, you'll start to see them. And that's one that we're working on right now. The bottom line is one of the best ways to start is talk to your friends that have been very happy. Now, you can't just say, are you happy? Yeah, I'm happy. Why are you happy? What is it about this person that you're pleased with? What do you need? You need somebody who's going to listen to what you need. What are your risks and your parameters and your time frames and your tolerances, right? One of my favorite sayings is, and I'll pick on you, Sheldon, since I can see you on the screen here. If I could guarantee to double your money, right? Let's just pretend for a moment I could guarantee it. And I say, in 1 year, I'll double your money. But you die of an ulcer because the volatility of it all just made you insane. What was the point, right? So what's really important is to understand, yeah, exactly. If it'd be true, it'd be interesting. But the whole point is, if you're asleep, if you can't sleep at night, something's wrong. It's the number one way I tell if I'm uncomfortable with how I'm managing money is I won't sleep at night. I go, okay, and I keep, my subconscious will start to work on it. But through the last 4 months, for instance, I slept like a baby. So it makes me know that, okay, there's nothing really, I mean, there's lots that I'm always worried about, but it's not really worrying me. So you need to have something that connects like that. You can look at returns. There's nothing wrong with that, but are the returns meaningful for what you need? So with a mutual fund, sure, the return's meaningful. But the problem with the mutual fund is you have to fit the criteria of the fund. So it says, here's our prospectus. This is how we manage money. If that meets your goals and risk parameters, congratulations, go ahead and buy. If it doesn't, don't buy. But you now have to match them rather than an advisor who's supposed to match you. And so a good advisor, you know, one of the best things you can look for in an advisor is an advisor who will say no, right? Sheldon, I'll pick on you again. So you come to me and you say, look, I need you to double my money in the next 6 months, okay? I can afford it. I don't mind. It's the way I like to play. Use leverage. That's what I want. I'd look at you and I'd say, Sheldon, I'm the exact wrong person for you. I don't invest that way. I can't make money that way for myself. If I can't do it for me, I'm not going to do it for you. I don't like playing options. I don't like being that aggressive. I'm not the right guy for you. And if I know somebody that's like that, I'll point you to them and say, go talk to them. They might be a better fit. Now, it could be the other way too. Somebody's afraid to death of certain investments, and they come to a guy that's all he does. What you want is a guy that's going to be honest enough to tell you the good and the bad and the ugly. That's what I look for. But start with friends and referrals, but make sure you understand, because, you know, we've all had, I made money on this stock. You should buy it. It's great. I'm doing great in it. Well, nobody asks you, well, when did you buy it? Well, I bought it a year ago at 1/10 the price. Well, of course you're happy. Doesn't tell me the risk is good now, right? So you got to grill them as to why they're so excited or why they're pleased.
Thank you. Here's another question that's asked privately. Shouldn't money managers be bonded, or I'm not sure if it's SDIC or SIPC insured. I'm not sure. What, either way, bonded or insured?
You're confusing some things. SIPC is for brokers. That's for a broker dealer. Broker dealer is the one that holds your assets. An investment advisor, I never touch your money. It's held at Fidelity in your name. I can go trade for you. I can't take the money. I can't touch the money. The reason Bernie Madoff was able to commit the crime is he was a broker dealer holding the assets. So he held the assets. He created the fraudulent reports. So everything's held at Fidelity. I can't create a fraud. Even if I did, Fidelity sends statements directly to you. So SIPC is for the broker dealer that holds the assets. If an RIA takes custody, which means they are holding the assets for you, then yes, they by law must be bonded and insured. Most RIAs go the other way. Certainly Harmony does, which is, I don't want custody. And the reason is real simple. Why do I need it? There's no good reason for you to hand money to me. I don't have to touch it to invest it. I don't have to touch it to understand your risk parameters, your goals. I don't have to touch it to be able to send it to you, right? Oh, Alan, I need $10,000. Fine. I can go to Fidelity and say, send them $10,000. Okay. But because I don't need any of that, so if I get run over by a truck or anything more criminal, I can't really touch your stuff. And if somehow I manage to, Fidelity, because they are insured, will actually pay you back while I go to jail. So we are not bonded, because I don't want you to give me money. I would never have you send me a check. I'd never have you send me a certificate. I have, for some older clients before, actually driven them to the Fidelity office so they could make a deposit, because I didn't want to take the check.
Thank you. That clarifies it. Are there any other questions? I didn't get any more in my private chat. Any other questions? If you have a question, feel free to unmute your mic or type it in. It's probably easier to unmute and ask. Here we go, Mary.
What about investing in precious metals?
I actually like it. The last 2 years, gold stocks have been top performers. Now, I typically, for clients, we invest in an ETF. Let me know if people need to know what an ETF is. What's that?
You might as well.
Rabbi? Yeah. Okay. So an ETF is like a mutual fund. It's very similar. So let's define a mutual fund. A mutual fund is a group of people that commingle their money, have a professional manager managing it for a specific goal and risk parameter. It trades only at the end of the day. So at 4 o'clock, if you buy it or sell it, it waits till 4 o'clock, gets the pricing of all the things in the portfolio, says here's what the value is, and that's what you pay. An ETF is the same thing. Bunch of people go in that don't know each other, buy into the same thing. It has a list of securities that they invest in or a strategy. It may be active, so it has a professional manager, or it may be passive. Still has a professional manager, but he's not picking stocks. But that trades all day long. Trades on the exchanges, and you can buy it during normal hours. There's some difference in tax advantages, but we're not going to worry about that for this. So we buy an ETF because it is a fixed group of securities, what I know exactly what they are and what their weightings are in the gold industry. I used to research and pick individual gold miners. That's gotten more difficult for a number of reasons. But bottom line is I'm much happier these days using the ETF. Gold, if you give me 2 seconds, using that ETF, it's still thinking. Okay, is up 17.9% through today for this year. It went negative briefly. You can't see again. It's the gold one. It went negative briefly when the market tanked because with all the leverage in the marketplace, people sold anything and everything that they could sell. I'm just trying to set this up without it falling over. There we go. Here, I'll hunch down. So it went down because of that panic. But in my mind, we've got serious problems economically. And when the markets recognize that, gold probably continues to climb. It's not a huge position, but it's something I've liked for a long time. Silver is a little tougher. It tends to move with gold. The big issue with it is primarily used for industrial products. So if you get a recession, if you got a major recession where industry is down dramatically, there's less demand for silver. So it becomes more speculative in some ways, but at the same time, gold is primarily a hedge or a speculation because you're not buying it for what it's producing anyway. But I definitely like them.
All right, another question. I guess this is a private one again. It was follow up to the original question about the insurance and bonding.
Okay.
Fiduciary responsibility to the people you give advice to.
Absolutely. Not only by regulation, a registered investment advisor is a fiduciary, which means we are responsible to the client, which is why when somebody comes to me, if I'm a broker and Sheldon comes back and he says, double my money, you know, I can do it. There's nothing unethical with me saying, well, I'll do my best here and we'll give it a shot. As an RIA, I have a double responsibility. Number one is I might look at Sheldon and go, you can't afford that risk. That's nuts. And in which case, if I do the investing, I'm liable for it. Period. End of the discussion. If I thought, no, he can't afford it, that's okay. It's not unreasonable. He's not doing it with 100% of his money. You know, he's doing it with a small amount and all of this. And I think I could do it, then that's fine. And if I lose money, I'm not liable for that because we can't guarantee making a rate of return. But I do have a fiduciary responsibility to do what is in the best interest of the client. So, you know, a long time ago, the last time I got paid with commissions was 1993. They started getting rid of commissions for most advisors about 5, 7, 8 years ago. So I was very early. And the reason was I looked and I said, well, I don't want anybody ever asking, why did you do that trade? Was it because you think it's a good idea or was it because you need some money this month? So that's why we got rid of that and went to a fee, because I said, there should never be a question that I only represent one person, that's the client. So one of the things, and it's a good thing to ask an advisor, do they accept soft dollar agreements? Soft dollar agreement is where I say, this system that I showed you the charts is something called Icon, costs about $20,000 a year. It's from Reuters originally. Now, a lot of places, if I do trading with them, I'm effectively paying them by guiding the trades through them. And for that, they may give me the icon for free or just charge me maybe $1,000 a year or something, depending on how much trading I do. That's called a soft dollar arrangement, where I'm giving them business, I'm driving business to them in order to get something from them. So the first question is asked, do you accept soft dollar agreements? It says right in our ADV, we do not have soft dollar agreements and will not have soft dollar agreements. If we can't afford to pay for it, we don't do it because it becomes a conflict. Well, why'd you trade through Reuters? Why not Fidelity? Why not Schwab? Right? The only thing that should matter is that we're getting you the best execution at the reasonable price. So that's that. I probably overkilled on that. Did that help explain it?
Yeah, that was perfect. Any other questions? I don't see any unmuted mics. Or Judy, I saw you unmuted your mic earlier. Let me see.
Well, I just had a little story about myself to do with stocks. I have zero risk tolerance, not even 5% risk tolerance, zeros. I took a high school course and one of the assignments was to pick a stock and watch it. And I picked Ideal Cement. I remember the name to this day. I figured cement is a sure thing. Everybody's using it. They need it for so many different things. So the first day I bought it, I think it was $11 a share. And then the next day it went to $10 a share, $9 a share, disappeared, never came back. And I said, okay, I'm done with stocks. But I will tell you, I had a financial advisor back east, and I liked him very much, and I'm sure he did, the best to his ability and knowledge, etc. He and my ex-husband tried to double team me because I had all these safe investments, and they said you have to get the AIG. It was really high yield and whatever. And I just put my foot down, and you know what very well what happened with that. That disappeared. Although I did get a AIG, but it was a fixed amount, and I did get the capital and interest on that. And that's my two experiences with stocks.
Well, and that's the really important thing. Look, you'll find other people that like stocks. I love stocks. I love it for lots of reasons. But the whole key is your risk tolerance. It goes back to that. If I could sit there and guarantee to double it for you, Judy, but you end up with a heart attack because it goes down and then it goes up and down. I didn't do you any favors. Doesn't matter that I doubled it, right? So it's really critical that you pay attention. You did the right thing by putting your foot down, saying wrong. My wife is very similar to you. She's, after 23 years, getting a little more comfortable with my managing some of it, but there's still a portion that she wants to know that it's safe and that it's money market, it's CD, that's fine. And so guess what? Part of it's that way. Even though I say that doesn't make sense, the fact is for her, a peace of mind, it does make sense. And for the peace of our marriage, it makes sense. So, listen to that inner voice, if you will. That's the critical thing. It doesn't matter what everybody else is doing. Greed is your biggest enemy when it comes to the investment world because it forces you to make the wrong decision at the wrong time. The reason wealthy people are luckier than non-wealthy people, and I mean truly wealthy people, right? Hundreds of millions of dollars. It's because they are allowed one thing that everybody else has to fight about, and that's patience. So when I ran Bernie Cantor's money at Cantor Fitzgerald, Bernie was number like 352 on the Forbes 500 list. And he made it all himself. A marvelous man. He was a terrific man. But he used to remind me, Alan, you can't make me rich. I'm already there. His official salary in 1990 was $1 million a month. It's not what he really earned. It was a lot more than that. But his point was, look, if I doubled what I was managing for him, it wouldn't change his lifestyle one iota. He had so much more than he ever could spend. Didn't matter. But if I lost it, if I sent him back to Brooklyn Poor, where he started from, boy, he'd be pissed, right? So he didn't care. If we found an idea and we missed it because it took too long for us to research it or get comfortable, who cares? We'll find the next thing,
Yeah.
right? What he didn't want is greed saying, quick, get in, it's before it's too late. And now you lose money. So be patient. And so it's the same thing as what you're talking about. You got to be comfortable with it, and you got to be willing to take the time and say, if I miss it, I miss it. So what?
But by the same token, I don't want to ever discourage anybody from doing stocks, but just to do research that they really understand what it is. And I think that that has
Correct.
the comfort factor. And when you talk about greed, that reminds me of a bank in Rhode Island that went out of business. They were giving a high amount to start an account there. I think it was something like 12 or 13%. And I just said, you know, it's too good to be true. There's something wrong with it. There's got to be something wrong with the business. And sure enough, it went under. And I hate to kind of say it, but the government gave people back the capital. And where does the government get the capital? They get it from the taxpayers. And I was kind of angry because here it is, I was not greedy and I was using, you know, what I thought was my brains. And other people were being very greedy and they ended up getting the capital back. So, I mean, in a way, I'm glad they got it back, but it was really at my expense.
Absolutely correct. Now, there is a logic to protecting the banks in some ways, but if you took it to today with all the money that's going to bail out corporations, I'd 100% echo your feelings. There's no reason to be bailing out Boeing or anybody else. That's what Chapter 11's for. They aren't going to lose any more employees than they would anyway. They'll continue to operate, and no taxpayer had to bail out. The investors get hurt. That's who's taking the risk. That's who should be. And unfortunately, what's happened now is what we're doing is protecting investors rather than taxpayers. And that's not the right way. But I agree with you. And you're right. It's got to be personal. Your feeling about stocks is for you. That doesn't make it right for the next person. They have to look at their own situation and decide.
Thank you. Let's go 2 more questions because I know your time is valuable and it's already 1:35. So the first question I think is the easier one. These are both messaged privately. Where is the best place to purchase gold bullion? I don't know if that's an easy question.
I don't know if there's a best place. What you typically can do is check around a number of places and see the differences in the spreads. Fidelity now can buy and sell bullion for you. They can hold it for you or not. I've tested that because I wanted to figure it out for some clients. So I bought a little bit for myself to see how it worked. And they actually don't do it themselves. They've partnered with somebody whose specialty is the precious metals. There are, and I just don't remember most of the names, but there are groups out there. You can research it, Google it, and you'll find. Go to an institutional place. Don't go to the retail guy on the corner. You'll get ripped off. The banks probably be more expensive if they do it than other places. And the way they typically do it is they may charge a fee, but it's typically in the spread. So you look at the spot market, which is the current, here's the price of bullion today for a, whether it's a 1 ounce bar, it's a 16 ounce bar, or whatever it is. They'll quote a spread and you compare it to the spot. And that's how you price it. And then you have to figure out if you're going to buy bullion, it needs to be assayed when you sell it. So you run into a bunch of other things you have to deal with. If you take the bullion and you keep it in your safe, when you go to sell it, they are likely to demand that it gets assayed again so that they can be sure that you didn't trim some gold off or pay gold paint on an iron bar, or, any of these things, which is why a lot of times people buy it, but then have it housed so they don't have to pay for it to be assayed a second time.
Okay, thank you. And then the last question is going to be a little bit longer, but you can keep it brief. As one gets older and there's a need to protect from that original questionnaire, do you have a formula for how much of one's assets should be in fixed and speculative investments?
I throw the dice and whatever it says. Again, it really depends on the person's situation. I'll give you two examples. They're extremes intentionally. Client A needs $100,000 a year to retire. They're long since retired, and they've got $10 million in assets, which means at 1%, they're making $1 million a year, which is 10 times what they needed. Okay? In that case, if the market had sold off dramatically and stayed down, you might argue to buy stocks for them that have dividends. Say, we're generating even more yield, but we squeezed out all the risk. So you might do some stocks at that point. Maybe it'll be 25, 30%. There's no reason to 100% because they just don't need it. They got 10 times what they need. In a time like this, I'd probably be looking at T-bills, very short-term, high-quality corporates, and I wouldn't own any stocks. Again, because it's the risk reward. If I double their money, doesn't do them any good. I actually had a client come to me a couple of years ago, pressuring me, why aren't you buying more? Why aren't you buying more? And I looked at him and I said, I'm going to buy everything for you and we're going to double your money. Are you going on more vacations? And he looks at me. He's been a client of mine for 25 years. No. You going to buy a bunch of new cars? Alan, of course not. Well, are you going to go buy a bunch of new clothes? No. So tell me, Bob, why are we doing it? And it was like a light bulb went off. You're not going to do anything with it. What do you need it for? I mean, it's not that we give away the profits, but why are we taking the risk if the reward doesn't justify it? And if you've got more money than you can ever use, and less risks have simply been washed out, why are you taking the risk? So that's the one example. The other is the exact opposite. Okay, needs $100,000 a year. He has $1 million in savings. He needs 10% to generate his return. He's got to be more aggressive because he ain't going to make that in a bond, right? 10-year Treasury is sitting at a 0.8, call it about a 0.8% a year. That's for 10 years, right? If you go to 1 or 2 months, you'll be lucky if you get anything. Money market right now is not yielding 1%, but 0.01%, 1/100th of a percent. So, in that case, that person's going to have to be more aggressive in order to get anywhere close. And then what we'd probably do with them is actually say, given the risks right now, you're going to have to spend down part of your capital. And when risks go down, then we can change it. But let's not buy it up here. So we'd probably do a blend. So getting back to the specific person, the problem is without knowing your situation, I have no idea what's appropriate for you. And if I don't know what's appropriate, I don't know what I'm trying to achieve. And if I don't know what I'm trying to achieve, I got no way to answer the question. So I got to understand all of that, and then I could tell you. But it's going to be different for everybody depending on their situation.
Okay, that makes sense. Thank you. So here's the last question because it just came up, but I'll make sure it's the last question. I think it's I
can stay. I don't have another meeting today. I'm done for the day. So if people have more questions, sign off when you need to. But I'm not in a rush at this point, just so you know.
Well, either way, what are the rates of Treasury bills?
Yeah.
What increment do you have to buy them in? And can people buy Treasury bills through you, or is it all on the internet?
You can buy them through me, and I do it as a service because if I charged any fee, it would wipe out what little yield there is. But you can also buy them directly from the Treasury on the internet. You can also buy them at a Schwab or a Fidelity directly. Depending on what it is you're buying specifically, the amounts change. I believe with Treasuries, the minimum's $1,000. But I haven't played in the lower end of that size enough that I have paid attention to the rules anymore. But I believe it's $1,000. Yields right now, to give you an idea, because I think that was part of the question, 3-month Treasury right now is yielding 0.17%. The 10-year is Treasuries rallied today, so 0.73% on the 10-year. So anywhere from nothing to almost nothing.
So that wouldn't be a sound investment, at least not today.
No, it's not. No, that's not true. Okay, no, that's not fair. Depends what you're trying to achieve. If you need absolute liquidity and you can't afford interest rate risk, guys, if you can't afford interest rate risk, if you need the money in just a very short little while, because if interest rates rise, bond prices fall. So if you buy a 10-year bond, regardless of who the issuer is, and 10-year, we're going to say it's going to pay you 10%. And then next year, it's now a 9-year bond. Somebody can buy that exact same bond, but instead of getting 10%, they get 11%. Okay? So the interest rate went up from 10 to 11. They can either buy that new one at 11%, or they can buy yours at 10%. Now, the one at 11% is going to cost them $1,000. So are they going to pay you $1,000 to only get 10%? No, they're going to pay you less. So the interest rate went up, the price went down. The exact opposite is true as well. So if you can't afford, because it's 10 years and interest rates go up and now you lose 5 or 10% on your bond, if you can't afford that, then you might want to be very short term. That's a perfectly good reason. If money market's only 0.01% and the 3-month Treasury is 0.17, I'd take the 0.17 over it all day long. Are you going to get rich on it? No. But there's a reason, there's a value to it.
Thank you.
So it's all about strategy. It's all about what are we trying to accomplish, which means time frame, risk tolerance, and goals.
Thank you. All right. Any last questions? If not, I will say thank you very much, Alan. And I'm going to share
My pleasure.
anyone who does want to find out more about Alan and Harmony. I'll put the website tomorrow in our email, not tomorrow, on Friday. And I just wanted to mention one other thing. There is a presentation lecture on Sunday, June 21st called Daughter of Hamas, or Jewish Daughter of Hamas, actually. That's really what it is. That she'll be presenting on Sunday, June 21st. It's free, 6:30 p.m. in the evening. It's in our email. There will be also a larger email for that, just putting that date on the calendar. But again, I hope to see everyone here on Friday. We don't have a presenter. He just backed out. So, Alan, you might have to do it again.
Okay.
Well,
hey, give it a week. There'll be all sorts of new information.
A week. It's 2 days. It's this Friday. But we'll have a presenter, and I'll put in the email. I've already gotten a couple of leads on that. So, again, look out for an email on Friday morning. It will be a surprise guest. You never know who. But thank you again, Alan, and thank you for all this.
Thank you, everyone. I appreciate the time. I enjoyed it.
Thank you.